Welcome to this webinar to help improve your knowledge of the Teacher's Pension Scheme and the main considerations for planning the retirement that you want on your own terms. Let's start by telling you a little bit about who we are. Wesleyan Assurance Society is a mutual, which means it has no shareholders and can keep focus and stay true to the needs of its members and customers, with members being able to choose their own package of benefits. Wesleyan Assurance Society's financial strength comes from its purpose and long-standing way of doing business that has always put its values and the needs of its members and customers ahead of short-term gain. For more than 180 years, it has been creating a brighter financial future across the UK in an ever-changing world. Wesleyan Assurance Society's award-winning in-house team puts investors first, and in 2023 was named Investment Team of the Year at the Insurance Asset Risk Awards. Wesleyan Financial Services is the financial advice arm of Wesleyan Group of companies and is wholly owned by Wesleyan Assurance Society. Exceptional personalized service and strong relationships are provided by specialist financial advisors who deliver tailored financial advice to support society's most trusted professionals. As experts for society's most trusted professionals, we are committed to always having a deep and evolving understanding of everything our customers give to their careers. We can support you with financial advice, products, and services throughout your life and career, from your first steps on the career ladder to buying your first house, protecting your family and valuables, saving for your children's university fees, planning your retirement, or leaving an inheritance to your family, plus lots more in between. This webinar is designed to touch upon how you can get the pension that you need and explain more about the scheme itself. The key areas we'll be covering off today are types of membership and the various sections within them, how to increase your benefits, alternative ways of saving for retirement, then finally, what your actions and next steps should be following this webinar.
So, let's look now at the Teacher's Pension Scheme and how it works. It's classed as a defined benefit scheme, which means it doesn't have an immediate cash value. Your benefits are based on two fundamental factors. One is length of service, and the other is either your final salary or the average salary over your career. Whilst you are a scheme member, you pay a set contribution rate to retain membership of the scheme that is tiered based on your salary. An often unknown but significant benefit of the scheme is the employer contribution, which recently increased to 28.68% in addition to this. So your employer contribution exceeds the personal contribution and so is a valuable benefit. Now moving on to the actual calculations. How your pension is calculated depends on which section of the scheme you have benefits in. The pension taken will be taxed as income, but a tax-free lump sum may also be available depending on the section of the scheme you're in. This means that there are different member types within the scheme. Some members remained in the final salary arrangements only. Some will have a pension in both final salary and career average, and new members, those who join the scheme on or after the 1st of April 2015, will be in the career average arrangement. There are two things to note here. The pre-2007 scheme automatically comes with a tax-free lump sum. The other two don't, but you can exchange some of your pension to obtain a lump sum. This is something we could run through after viewing your pension statement. So although this can look like a complex and daunting process, we can go through it together to look at your specific circumstances. This will also enable you to see what your retirement income will look like on a monthly basis and what tax-free lump sum you'd be entitled to when you decide to take your benefits. The level of all benefits is linked to your length of service and salary. You can view your annual benefit statement for both schemes online, which gives you an overview of your benefits. If you're not sure what you're entitled to, we can look at these in more detail in a one-to-one appointment. In addition to a pension, the scheme also offers you death in service and family benefits to protect your loved ones. In the event of your death while you are still working and not taking retirement benefits, death in service benefits provide your family with a lump sum of 3 times your annual pensionable salary. Your dependents, a surviving spouse, registered civil partner, or subject to certain qualifying conditions, a cohabiting partner, are also eligible for a survivor's pension, which is ongoing for the rest of their lives and is payable immediately after your death. In addition, there is a provision for ill health retirement. This means that your pension can be paid early if the scheme decides you are permanently unable to do your job due to ill health or any other job.
At Wesleyan, we understand that teaching is a demanding profession, and to that end, retiring early is a key driver for many educational professionals. There are several questions that will need to be considered if this is a feasible option for you. First question to consider is twofold. What exactly counts as retirement, and what is early? We've mentioned this area earlier, and retirement usually means finishing work, but that doesn't necessarily mean putting your feet up for the rest of your life. Perhaps you still want to work and earn in some way, just not in the way you have been. What about early? You can consider early retirement to be any retirement before the normal pension age, but we'll focus mainly on a retirement that happens for some in their 50s. We have seen more people leaving their profession completely, but in this case, you need to consider how you will be spending your time. The key age for any pensions is currently 55. At this age, you can draw down on any pensions, whether that's the teacher's pension scheme or any other pension you may hold. There are some key points you'll need to be aware of in terms of when you access your pension, ranging from actuarially adjusted benefits to your employer putting forward premature retirement to you, plus other options such as phased retirement, retire and return, and age-related benefits. Again, we can help you navigate your way through all these, as each scenario carries its own complexities, which you must understand before making a commitment. Phased retirement has increased in popularity in recent years as education professionals seek to work longer, but reducing their hours to start the adjustment to life outside of work. It removes the cliff edge that some people can find retirement can bring. What phased retirement allows you to do is that providing you reduce your working week by at least 20%, from a full-time contract to anything that is zero point 0.8 or below, it enables you to access up to 75% of your pension and lump sum. You can continue to remain in the teacher's pension scheme and accrue further benefits to the 25% still retained within it. And then when you decide to retire altogether, you can take the remaining benefits out of the scheme. This may well give you the option to have the best of both worlds, to begin to enjoy the start of the retirement whilst continuing to teach, just maybe not at the level you were. It also allows you to maintain permanency of employment. But please be aware that any benefits taken prior to your normal retirement age will receive an actuarial reduction applied to them. Again, this is something we can discuss to help you understand how these figures will be applied to you. For those of you who want to take benefits at your normal retirement age or beyond and still go back to teaching, there are some restrictions applied by the scheme. The abatement rule states that if a retired teacher returns to work and their combined earnings, salary and pension, exceed their salary of reference, this is usually their highest salary during the final working period, their pension will be reduced to ensure their total earnings do not surpass this reference point. So, if I was earning £40,000 teaching the year before my retirement and my pension was £20,000, the abatement rule means I'm restricted in earning anything over what I earned in the previous 365 days. Therefore, with my pension income and my teaching income, I would be capped at a level of £40,000. This rule would not come into effect if an actuarial reduction is applied to the pension. Please note, this rule is only relevant if returning to a role that gives access to the teacher's pension scheme. A return to a role outside of teaching means the abatement rule does not apply. Let's move on to an example where we look at the potential financial impact of retiring at someone's normal retirement date versus retiring early. Sarah was 40 on April 1st, 2025, with a current salary of £49,084. Following the MacLeod remedy, she has 18 years total reckonable teaching service in the 80th Legacy Final Salary Scheme and benefits in the Career Average Scheme from 2022. Her normal pension age for the 80th benefits is 60 and 68 for the Career Average benefits. If she retires at 60 and takes all of her benefits, she will receive the following. From the final salary scheme, she will get 1/80th multiplied by that final salary of £49,084, multiplied the number of years, which is 18. That calculation gives a pension of £11,044 per year. From the final salary scheme, she also receives the automatic tax-free lump sum of £33,132. From the career average scheme, she will get a 57th, which is the accrual rate for that scheme, multiplied by that salary of £49,084, multiplied by 18 years as well. That is then added to by inflation plus 1.6%. That calculation gives us 24,455. As she is accessing these benefits early, these will be reduced by actuarially adjusted benefits by a reduction factor down to 0.72163, which gives an annual pension of £17,647 per year. There is no automatic lump sum with this scheme. Another feature of the scheme is taking an enhanced lump sum. If you recall from the previous slide, Sarah's combined pension from both schemes would be £28,691. She also would get that one-off tax-free lump sum of £33,132. Sarah has the option to take a bigger lump sum, the maximum of which, based on these figures, is £134,795. This would reduce her annual pension to £20,219. These are maxima and minima options. You can go in between these as well. The commutation rate for the teacher's pension scheme is £1 to £12. That means for every £1 of pension you choose to give up, the lump sum will be increased by £12. Considerations as to whether this is right for you are primarily fixed or essential living costs. This option trades guaranteed lifetime income for a finite tax-free capital lump sum. Is this affordable in the long term? Capital needs over time. Will this flexibility allow you to cover costs that other assets won't? Remember, this is a one-off and irreversible decision. Are you certain of what you are doing and why? Specialist advice will cover all options with you to assist in your decision, but we cannot recommend as this is a very personal outcome.
Running alongside your TPS provision, let's now look at what the state will provide. Until April 2016, the Teachers' Pension Scheme automatically contracted members out of the additional state pension, allowing both employer and employee to pay lower national insurance contributions. The state pension and the additional state pension have now been replaced by the flat rate state pension. An individual's national insurance record will be used to calculate the single-tier state pension. A year in which an individual has paid the necessary national insurance contributions is known as a qualifying year. Those with less than 35 qualifying years will receive a pro rata amount of pension, subject to them having at least 10 qualifying years. The single tier state pension will be determined individually with a starting amount for each individual at April 2016, which takes into account their existing national insurance record and make deductions for the time the individual was contracted out. Spouses, registered civil partners, will no longer be able to inherit rights from their partner's national insurance record. To sum up, the current flat rate state pension is £230.25 per week, and you will need 35 years qualifying national insurance contributions to be able to access this. In line with reviewing your teacher's pension scheme figures, it is wise to obtain an online forecast of your state pension. If there are any gaps or you are behind the 35 years service, there are ways you can make additional voluntary contributions through Class 3 national insurance payments. This is something you will need advice with that we can discuss together to ensure you are maximizing the opportunities available to you.
Whatever your pension age or access stage, you must fully understand the pension you need. In a previous section, we talked about financial independence. What does this really mean? All this means is that your outgoings over the rest of your life don't exceed your income and savings. Once you put it in those stark terms, you can break your ambition down into goals. First, paying off any debts. Clearing these will only help as less stress on the expenditure in retirement. A big part of this may mean paying off your mortgage. It's likely to also be the biggest monthly expense, and therefore the biggest saving when wanting to retire early. You need to work out your income needs in retirement to ensure your daily needs are covered, plus any other outgoings. You'll need to work out the minimum you'll need to spend each year to have the lifestyle you want. For the moment, forget things like luxuries and holidays. They will come later. First, get down your basic budget for essentials. It's sensible to suppose your basic needs won't change much. However, you should be able to deduct regular expenses, such as mortgage repayments and any servicing debt, assuming that you've dealt with those issues above. You can also discount any necessary expenses that's specifically related to your working life, such as daily travel costs. Similarly, if you have children, they are likely to be grown up by then. Though they may still need financial help from you, this will count as discretionary spending. So, deduct child-related costs for now. You should aim to arrive at a single monthly and yearly figure for your essentials. Remember that costs will rise gradually with inflation year on year. Also, consider that in your final years, you may need to find money to pay for care. You'll then need to consider your additional funds so you can really enjoy life. This becomes your discretionary spending in retirement. This may be the hardest figure to estimate. You'll need to think in detail about your plans for retirement, where you want to live, how many holidays you'll take, what interests you'll pursue, even what vehicles you want to own. Maybe you've always dreamed of owning your own boat. This can be called discretionary spending. Again, assume that your costs will rise with inflation over time, but also that your lifestyle may modify in later life as you slow down. It's important to estimate your total costs over retirement, combining your essential and discretionary spending. You now need to judge whether your assets can meet two different targets: essentials only or essentials plus discretionary spending. Now, estimate the length of your retirement. If you're retiring age 55, then 30 years is a reasonable figure. The next step is to find out whether your assets can cover those levels for spending over this longer term. The other side to this is calculating what income you can achieve in retirement. Make an inventory of all your assets to see where your retirement income could come from. Assets may include private or workplace pension pots, including those that may be final salary based. In this video, you will see how a specialist financial advisor from Wesleyan Financial Services would use a cash flow model as part of the advice process, which can help you put together a financial plan that may make your money work harder in the short, medium, and long term. This planning can be broken down into 5 simple steps. We'll then develop a tailored plan to achieve these goals and set out the specific action you need to take.
Do you know what the potential of your financial future is? It's understandable if the what-ifs are completely overwhelming. We've developed the Cash Flow Modeler tool to help you build a realistic and informed financial plan of your income and outgoings for both now and in the future. Our customisable tool helps you visualise your life in numbers. It'll identify risks, play out different scenarios, and sketch out a financial roadmap for what your next steps are and what happens if you don't do them. Seeing your future in numbers can empower you to answer questions such as, when's the earliest that I can retire? How can you achieve your dream retirement goals? Or show you how to pass your wealth on to your family tax efficiently. The Cashflow Modeler tool means you don't need to compromise or rush your decisions for your retirement. It allows you to test all the variables, compare investments, and show you if you're moving in the right direction. It accounts for high or low inflation, different pension and investment performances, and can incorporate any major life changes that might pop up. No matter what your age, don't leave the path you travel to chance. Plot out your desired outcome, and the Wesleyan Cashflow Modeler tool will show you the best way to achieve it, putting your future firmly back in your hands. Wherever you are on life's journey, Wesleyan will be with you every step of the way.
Other assets that could support your retirement may include private or workplace pension pots, as well as savings and investments. Another potential is property. You may be looking to downsize or release equity from your home or have other property to let or sell. These are also likely to be other income streams personal to you. State pension will come at a future point, but often there is a gap between retirement from teaching and the receipt of state pension. Partners are a key consideration here also. If you run a joint household, how does your pension work with theirs? Joint reviews add value to anyone's financial planning where there is a partner. With all these factors considered, you can work out whether your combined assets will be enough to generate sufficient income over the length of your retirement. Overall, your income needs can be met in a flexible way by considering what assets you have and how and when they can best be utilized. Tax is a big consideration here, as is the type of asset you hold. Specialist advice, in conjunction with cash flow modeling and pinpointing objectives, can assist you with the building of your bespoke strategy. What if you don't have investments? A number of people have accrued cash but have never invested. What is the difference? Money has only got a value when you spend it. If you are not going to spend it today, but you are going to spend it next year, then if the goods or services that you want to buy are more expensive next year, then you can buy less goods and services. The goal of investing is for your money to keep pace with inflation, so you can buy the same number of goods or services. Or to grow at higher than inflation, so your money can buy more goods and services. The challenge is for savers to ensure their savings are outgrowing inflation rates. The money you hold onto as cash slowly loses its buying power due to inflation. However, By investing, you can expect to achieve high returns over time with the aim of at least beating inflation. You may ask why there is any risk in having cash deposits at all. The risk here lies in inflation itself. Assuming that the inflation rate is around 2% based on a long-term period, if you put £10,000 into a bank account with 0% interest, this would only be worth £9,804 in 1 year's time, £9,057 in 5 years' time, £8,203 in 10 years' time. So, if you don't put your money into savings or investments where the interest rate outstrips inflation, your fund could potentially lose money.
So, what should you do now? Decide which retirement is right for you, know how and when to apply for your benefits, consider carefully the options you have and how to take your benefits, understand lump sum investments products you may need to consider, look at your options for returning to work, how we will provide advice to you, agree needs and services, whatever they may be. We will then gather the data, analyze the requirements, and then we will present it to you and discuss your pathway. So, what's next? You can see from our discussion, this is a complex area with lots of key considerations. That's why it is important to develop your retirement planning strategy as soon as possible to maximize the number of opportunities you have. We recommend that your first step is to arrange a conversation with our local specialist financial advisor. Step 2 is to discuss your unique financial planning needs and to assess what you can do now to start maximizing the amount you have at retirement. Step 3 is us working together to develop and, most importantly, maintain your strategic financial plan. Charges may apply. We will not charge you until you have agreed the services you require and the associated costs. I hope you find this useful. Thank you for watching.